Okay, well, we'll get started. I'll start with an introduction. Welcome everyone. Today's Emerging Market Strategy Update webinar is going to focus on China. I'm Eric Anderson. I'm the head of Emerging Market Investments at Milltrust International, which is a London and Singapore-based asset manager with a core focus on delivering global emerging markets investment solutions to investors. For today, after an intro from me, we're going to hear from the China investment manager Xingtai Capital, an independently owned asset manager that has been investing successfully in China as a firm since 2014 and provide a very differentiated and unique portfolio. If you look at today's portfolio, less than 1.5% of the current exposure overlaps with the MSCI China Index. Xingtai are fundamental bottom-up stock pickers at their core. They're value-driven investors in Chinese growth, which has resulted in a portfolio averaging 36% EPS growth and 14 times PE. They have a track record of being early to spot winners at attractive valuations, while also having the discipline to avoid crowded and often poorly performing momentum trades. As an example, they're one of the few China long-only funds with a positive performance in 2018. Today, we're going to hear from Michelle Leung, the CEO and founder of Xingtai Capital, who sits on the investment committee and also serves as chairman of their board. We will then have an opportunity to open up to questions from the listeners. Although having spoken to Michelle just a few minutes ago, she's happy to take questions throughout the presentations. So to do so, simply type it in the Q&A section in your Zoom panel, and you can ask them at any time during the presentation, and we'll get to them whenever we can. We're going to try to keep this to 30 minutes, so 30, 35 minutes. So if we can't answer all the questions, we'll certainly follow up afterwards. And as normal, before heading up to Xingtai, a quick word on Milltrust and how we fit in. Our approach at Milltrust is to identify leading locally based investment managers in each of the key countries and regions across the emerging markets who are specialists in putting together high conviction portfolios of high quality companies. Each specialist team, which you can see here on the map, manages the regional portfolio within a sub-fund on the Milltrust Emerging Markets Platform. These sub-funds form the basis of our global EM strategy. Investors can either invest directly into the sub-funds, such as the Milltrust Xingtai China Fund, and build their own exposures to these countries and regions, or invest through the Milltrust Global Emerging Markets Fund, which allocates across the sub-funds on the platform. I think that's probably enough for me, so I'm going to hand it over to Michelle.
Thank you, Eric. And good afternoon to everyone. Thank you for joining the webinar. I'm Michelle Leung. I'm the founder and CEO of Xingtai Capital. I'm very happy to give you an overview of the firm, the strategy, and the portfolio today. And as Eric mentioned, we want to keep this more interactive and live. So if you have any questions along the way, just please jump in. So Xingtai Capital, we are a locally based investment management firm. We have an office in Shanghai, which is where the investment team sits. And then in Hong Kong, we are licensed under the Hong Kong SFC. We manage 3 fund vehicles, and our strategy is to capture Chinese growth with a value-driven approach. And I will explain what that means and how we do it. So inception for us was 2014. And we have always adopted this strategy of capturing growth with value from day one. And this has been a consistent, disciplined approach to our investment strategy. The portfolio is high growth. It's 30% EPS growth currently, with 14 times forward PEs. Historically, over the whole track record period of 6+ years, this has been a similar profile for the fund characteristics. So it's always been above 30% EPS growth. And the PE range has been between 13 to 17 times. But fair to say that we are very attractively valued as a portfolio compared to similar universe of stocks on the index and compared to other long-only China peer funds. We have been able to deliver very strong performance since inception. Our performance tends to be more pronounced in terms of outperformance over the longer term. So over 3 years, we're annualizing around 25%, and over 5 years, we're annualizing around 28%. So I'll briefly go through a little bit about the firm before I go into the strategy. So this is us. We're 14 of us based between Shanghai and Hong Kong. I'm the founder and CEO. My background prior to starting Xingtai Capital was on the private equity and operating side. I worked at Goldman Sachs. Then I worked for a listed company under the Hutchison Wang Pro Group. I was a founder of a private equity fund, Luna Capital, prior to starting Xingtai Capital. My partner, Bing Chao, is a CIO. His background is all in equity research and from other well-known long-short funds. So he worked at Citadel and SAC in Hong Kong as an analyst. And prior to joining us, he was a China PM for an Asian absolute return fund under Lombard ODA. So we have very complementary backgrounds and complementary skill sets. And we both sit on the investment committee. Day-to-day, Bing Chao runs the investment portfolio and the investment team. And in Shanghai, he's one of 8 with 5 investment analysts, 1 ESG analyst, and 1 research analyst. All our operational and compliance functions and investor relation functions are run out of Hong Kong. So in Hong Kong, we're a team of 7. And we have our COO, Mu Yun, who joined us from Optimus Capital and Deloitte, who runs our operational infrastructure and compliance function. And we also have investor relation functions out of Hong Kong. So, oh, apologies. Apologies. I don't know what happened there. Let me try again, sorry.
If you need me to share, Michelle, I can share the presentation as well. Oh, there we go.
Okay, yeah, sorry about that. So currently firm-wide assets are around 600 million. And we manage 3 fund vehicles. We manage a Cayman Master Feeder Fund, where the majority of assets are around 300 million. We manage a UCITS fund where assets are around 200 million. And then we also manage the Milltrust China Fund. And today we're talking about the Milltrust China Fund. So I'm going to talk a little bit about our strategy and investment philosophy. We consider ourselves bottoms-up stock pickers, bottoms-up fundamental stock pickers. Everything we do is driven by I'm sorry about this. I don't know what's going on.
Yeah.
Okay, is that okay? Is that working?
No, we can't see the screen. We can't see it. Double-clicked. I can share it, Michelle, if it's easier.
Let's try again. Does that work now?
I just see a black screen.
Oh dear. Sorry about this.
Here, why don't I share it? I'll share it now. You tell me when to change the page. Oh, there we go. We're back.
Okay.
Okay, go ahead.
Okay.
Go ahead.
Okay. So we're bottoms-up stock pickers. Everything we do is driven off our investment philosophy. So our investment philosophy is to capture high growth with a value overlay. So I'm going to go a little bit into what we mean by growth and what we mean by value. So on the growth side, we're trying to capture the highest growth equities that we can invest in. So our criteria is we're looking for at least 25% earnings growth, looking out 3 years. And typically we will seek a 50% return on day 1 over the target holding period, which is 3 years. So we're trying to really pick the highest growth stocks. And typically most of the companies we're investing in, the growth is driven by consumption growth or domestic demand growth. So that's on the growth side. On the value side, it is our belief that you cannot just follow consensus and follow momentum in China. If you do that, that's a very crowded area of the market, and you will see very volatile returns. Sharp corrections, strong momentum when momentum is there, but it will not be consistent returns. And we don't believe in following momentum. We really believe in focusing on fundamentals. And we really believe that a value foundation in each investment decision is core to ensuring the floor value of the investment, but also core to our overall philosophy of being more cautious and being very focused on the margin of safety, which we believe is important given the volatility and the sharp market cycles that we see in China. So in every decision that we take, we really focus on the value side. And what we mean by that is we're trying to invest in stocks when the valuation is cheap relative to the sector average, cheap relative to other peer stocks, and ideally cheap relative to stock's own trading history. So on an absolute basis, typically when we first invest in stocks, the PE ranges would be anywhere from 6 times PE to less than 20 times PE. So typically we will never invest if the stock is higher than 20 times PE, everything, all else being equal. So this approach of capturing value and growth has been consistent from day one. We do believe this is differentiated. We don't see many other funds that are adopting this type of strategy. And as a result, we don't have a lot of the consensus momentum names in our portfolio. So we've never owned Tencent and Meituan. We have held Alibaba over a 2-year period a few years back. But typically the stocks you'll see in other long-only China funds, you will not see in our portfolio. So throughout our track record, as you can see from this page, our PE range has been around 13 to maximum 17 times. On average around 14 times, which it is today. And the EPS growth of the fund has been around 30%, currently around 36%. How do we do that? How do we find stocks that are high growth, yet attractively valued? What we do is we try to pick stocks that are off the radar of the larger investors. So we tend to invest in stocks that are either too small for the large investors to focus on, stocks that are small cap, sub $1 billion in market cap, or stocks that are misunderstood by the market. They could be secular growth companies, secular growth sectors where the market hasn't understood the growth potential or hasn't understood the business model. Or it could be stocks where the market cap has corrected a lot and then in the middle of a turnaround. And we understand that there's a recovery growth trajectory, but the market is not paying attention. So whatever the case may be, we typically are investing in stocks where we are one of the earlier institutional investors. And when we first invest, typically there is limited or no sell-side research coverage in the stock. So on this page, you'll see a number of stocks that we invested in during the past 4 years. Apart from Yihai and COPH, every other stock in this page we're still invested in today. And in each case, when we first invested, as you can see on the page, the valuation was anywhere from 7 to 13 times. I'm taking Anta Sports out of this picture because it's not as consistent with the theme of investing when this company is very small. We invested in Anta Sports as a large cap stock. This is atypical for us. Typically, when we invest, the stock is typically sub 1 billion. And what we do is we take a forward-looking 3-year view in terms of where we think the stock will get to in 3 years. And we interact with management very, very closely. So we will typically meet with management 1 to 3 times before we invest. And after we invest, we're checking with management every month. So we do believe, because of our close relationship with management and our regular interaction with management, we have an information edge in the stocks that we're invested in. We believe that we typically will know more about the company than most other investors in the companies we're invested in, because of how hands-on and how close we are with management and with any kind of future outlook in the company. So typically, we invest early, we're in early, and we've been fortunate in that our hit ratio for our top positions has been very, very high. So typically, we have seen in our top 5 and top 10 positions a hit ratio of above 90%. So our batting average is high. Typically, when we've done our work, when we've done our homework, and we find stocks that fit our investment framework, these stocks have performed really well. And as you see from the page, we've seen returns in the portfolio of stocks that have delivered 5x, 10x, 12x types of returns. And that in turn has driven the alpha generation of the fund. Because of our focus on being early and going into stocks that are off the radar of large investors, we're typically not that correlated with the index in the market. So as you see from this page, our correlation with the MSCI China is minimal, and we do not hold a lot of the consensus in names on index-based names. This strategy has outperformed a lot. So obviously this year is a tough year. Index is down around 19% currently. And we have also suffered a correction in portfolio performance, but we have outperformed. We have outperformed this year, and we've outperformed on a since inception basis for this fund. And we are confident that after this year, we will see a turnaround in the equity market. So I'll address that in a bit, but I just want to highlight the fact that outperformance has really been a key aspect of our performance profile. Another typical performance profile of our strategy is that we are able to capture downside by about 50%. So in any calendar year where you see performance correcting a lot, like this year or 2018, we have been able to capture downside. So in 2018, our performance was up 3%, the market was down 20%. So this is our 1, 3, 5 year performance for the Cayman Fund, which is the fund where we had the longest performance track record. As you can see, we have been able to generate net alpha over the MSCI China by greater than 15% on a 1, 3, and 5 year basis. This is the portfolio today. And before I go more into detail about what's in the portfolio and what we own, I will give a quick overview of macro conditions in China and our market outlook. So obviously it's been a tough year for China. Things started getting tough during the summer months because of the regulatory crackdowns from the government. We think we're about to see a turnaround in the market, and this is due to a couple of reasons. So on the macro side, we've seen a slowdown in growth in 3Q. So, in September and October data that came out showed a dip in retail sales, slowing GDP, and PMI data coming in below 50, showing, contraction in manufacturing output. A lot of people have said, is this structural? Are we seeing a slowdown in China? We believe it's cyclical. We believe that 3Q was a cyclically slow period for the Chinese economy. And this is due to a couple of factors. One was because of the regulatory crackdown and the resulting confusion on consumers' part in terms of how to spend money. Secondly, we saw sporadic COVID outbreaks all across China that led to quite broad-based lockdowns in a few of the major cities in northern and eastern China. Thirdly, we had an issue with power rationing. So certain provinces decided to ration power, which obviously led to some supply side issues that also led to slower growth. We also had a slowdown in the property development side with Evergrande and other defaults, which again impacted growth. So, what we've seen is between June and November, all data has suggested that China is in a slower growth trajectory. However, data that has been released more recently has shown some brighter signs of a turnaround. So first of all, we've seen PMI come in, traditional PMI come in above 50. This is just last week. Retail sales has improved, up 5%. PPI showed a tick up. So we are seeing the fact that we think that China is moving beyond the cyclical slowdown in Q3 and coming back into more of a recovery mode. We also have seen some encouraging signs in terms of on the policy side. After the crackdowns in July and August, we've seen a softening in tone from the government. they went back and they qualified the after-school tutoring policies, clarifying that, in fact, these companies will be granted licenses and conduct some business lines that are for profit. So I think the details of what the policy is less important. The fact that the government came out and softened their tone and showed that they were open-minded to feedback loops in terms of maybe having made a mistake with this policy initiative and thereby tweaking this policy is significant, because it shows the government is open to changing policy or open to tweaking policy in the face of feedback, which we think is significant. We also have seen some encouraging signs of ways the government is suggesting or thinking about helping the property developers and the property sector overall. So in September, the PBOC, the People Bank of China, announced that they would grant more favorable mortgage terms to homeowners, home lenders. And in November, Chengdu, the largest city in China with over 20 million in population, announced that they would be helping developers with more favorable loan terms. This is the first city in China to announce that. We believe that this is a first of other announcements that will come, where other cities, other provinces will announce relief measures for property developers. And we think this is significant because with some support and positive regulatory noise around the property development sector, that could lead to quite a big rebound for some of the property management services companies that we hold, and will also lead to an overall rebound in the equity markets. So overall, what we're seeing is softening in policy tone, no more new regulatory crackdowns announced since August, a turnaround in a cyclical slowdown that we saw in 3Q. So our outlook for the next few months is we think that the equity markets will rebound once we see more stabilization data and more supportive policies towards the property development sector. We believe this should happen in Q1 of 2022. So moving on to the portfolio. This is our portfolio, and this is actually quite consistent with what we've seen for our entire track record. So we have exposure predominantly in Hong Kong equities and A shares, with about 11% exposure in A shares. We are predominantly in mid-small cap, so 80+% of the portfolio in mid-small cap. Currently, the portfolio has 44 names. It's a concentrated portfolio with top 5 and top 10 names representing about 30%, and then top 10 names representing about close to 40 to 50% of the exposure. And as you can tell from our sector exposure, we are all mainly in companies where the growth is driven by urbanization, domestic demand, consumption growth. So the largest sector exposure is property management services, then apparel, consumer durables, sporting goods, and F&B. We also have exposure in some healthcare stocks, some education names that are not after-school tutoring names. But it's fair to say that most of the companies we own, the growth is driven by market growth. We tend to avoid sectors where we see government regulatory risk. So going on to give sort of further color about what's in the portfolio, on this page, you'll see top 5, bottom 5 attribution profile for the Milltrust China funds on a year-to-date basis as of end of October. So I'll just briefly go through this. I see we're running up on time limit here. So I'll briefly go through this to give you a flavor of what's in the portfolio. As you can tell from the sector attribution, we have a lot of, quite broad sector attribution across the whole fund. In terms of top 5, 361 and Xstep are sportswear names. They are mid-scale sportswear names where the growth is being driven by these companies' ability to sell sporting goods, sports apparel to more consumers in the 3rd and 4th tier cities in China. So currently sportswear is well penetrated in the 1st and 2nd tier cities in China, where Nike and Adidas have large market share. The largest market share player is Anta, but these names, 361 and Xstep, are unique in that they are able to tap into the more rural inland consumers. Bozidang and BM are apparel names. Bosidang is a down jacket manufacturer. BM is a high-end golf wear brand. We like consumer brands. We like brands we think have strong brand equity, where the growth is driven by the ability for the company to sell to a larger addressable audience. And both these names are showing that type of characteristic. So BM, for example, currently has 900 stores, and they're forecasted to grow to 2,000 stores. Dongjiang is an auto dealer name. So we're also very bullish about auto dealers and their ability to sell to a larger addressable audience of consumers. Their slowdown has been mainly driven by the supply side, by chip shortages. So demand is healthy, supply has been an issue this year. On the detraction side, most of these names are property management services names. Property management services names are, these are companies that are asset light. They provide services for residential and commercial properties. This is a very high growth sector and a very new sector. The first company was listed 5 years ago. And these companies are delivering north of 50% earnings growth. This year, we expect 50% earnings growth, and looking out for the next coming 3 years, we're expecting 40% earnings growth. This sector has seen a non-fundamental sentiment-driven correction. Share prices are down substantially because of the noise and regulatory issues around the property development sector. Although the two sectors are not correlated and not connected to each other, there has been an impact on the share price of these services names, which we believe will turn around once we see stabilization on the property development side. So we're expecting these names to deliver higher than 40% earnings growth looking at 3 years. And currently, the 8 names that we own are trading at around 9 to 10 times PE. So we'll stop there. That's the full sort of overview of where we are end of October, and I'll take any questions. Thank you.
Thank you, Michelle. I think you've answered a number of the questions as you spoke through about the regulatory environment, et cetera. But one question did come up was on the internet stocks. Obviously, your focus has been more on the consumer side, but I think we've all seen Alibaba and Tencent and the what's happened this year has been quite dramatic. Is there anything you can comment on the internet sector and going on into 2022 and your thoughts on that side?
Sure. So we have not had heavy exposure in TMT since day one. So the main reason we have not been investing in these names over the past 5 years is because valuations for our investment framework that are just too high. Most of these stocks were trading at sort of above 25, 30 times PE, which for us was not, we could not justify. So it's not because we don't like these companies, because growth is strong, and but it's really the valuation that we did not have comfort with. So obviously share prices have corrected a lot, and they're looking cheap, they're looking attractive at these levels. However, we do think that the regulatory outlook is a bit is not visible still. There may be further changes. So for example, as it relates to DD, we do believe that there's a lot of policies that will still be rolled out in terms of data protection, data secrecy that have not been implemented yet. We think that the policies around the e-commerce platforms, creating a more even playing field and regulating monopolistic market practice was actually positive and rational. We think that was a good thing because as a consumer company, like a lot of them in our portfolio, you're able now to sell your goods and products on a number of e-commerce platforms, whereas in the past you had to commit to one single platform. So that we think is a positive development for the market. But for us, we can see there's lots of value with a lot of these internet names, but because of the lack of visibility on the regulatory side, we don't think that we will be investing at this point.
Okay, no, that's been the right call this year. You've addressed most of the questions, so I think we might finish there. We've reached the half-hour mark. Again, I'm sure there'll be some follow-up questions. So please do send them through. And Michelle, thanks again for your presentation. Thanks everyone for joining the call. As a reminder, the China strategy is available on the Milltrust Emerging Markets Platform, and you can access through the Milltrust Xingtai China Fund or through the Milltrust Global Emerging Markets Fund. We'll be circulating a replay to those that want it and those that couldn't attend. But as I said, get in touch, and I think we'll finish the call. So thanks again for everyone joining, and then we'll be in touch. So thank you,
Thank you.
everyone.
Thank you.